Hey traders, Raghi here. We're going to kick off this premium video with a look at some of the longer term contracts that we've had our eye on, daily time frames in things like natural gas and things like crude oil, RBOB, soybeans, cattle, wheat. One of the things that we talked about not all that long ago, and I'll show you the relative performance graph, is focusing on commodity futures. And I know that sounds funny because it's the futures room, but futures rooms and futures trading oftentimes just get relegated to, well, let's day trade the S&P or NASDAQ Russell Dow if they're well-rounded. But remember that futures markets, commodity futures markets, extend far past those indices and even the treasuries, and even just sometimes a hyper focus on the currencies, treasuries, and indices, right? We have agricultural products, your grains, and then you have your meats, you have your softs, and even in there your metals. And there's something really interesting about the way in which tangible, what I call the grocery store to the world goods, there's something really interesting about the way they move. They're not always bamboozled by what happens in the equity markets and stimulus packages and the Federal Reserve. I mean, things like copper, which we'll talk about here today, haven't in any way budged from their reflection of what they have said is a consistent weakening and contraction of the global economic picture. In fact, crude, even though there's so much talk about production and production cuts and everything else, crude has been moving lower really for one big reason. Nobody wants it. We're not using enough of it. Now, right now, nobody wants it. Let me not get too bogged down in hyperbole, but overall the demand has been less. We've just been using less crude. And then of course we get this tsunami of a pandemic, and then all of a sudden no one's driving their cars and we're seeing no traffic. And I'm going to talk about the traffic site that I use to compare how we used to drive as a world to now, and we know that planes aren't flying in the same way. There's just not demand for crude, and it won't until we see traffic and the consumer pick up in terms of activity, right? These are things we want to keep in mind, and we need to be able to measure these things. So let's take a look at natural gas to kick this off. So one of the things that I was waiting for in natural gas was the market just sort of stall up here and give me a squat-bodied candle and form what I like to see after a big candle up day as a minor high and then coming back down. And we didn't get that today. In fact, what we got instead was just a sell-off. Now, there's typically two reactions we can get after a big candle like we got yesterday. Big is not arbitrary. Big is measured by the daily price movement range of that symbol. How do I get that? Straight on over to the auto chartist. Take a look at the natural gas front month. Look at the daily movement, and anything above about 0.09 is a pretty significant move. You get above 0.11, 0.115, you've got a move beyond the typical 68% probability. We had that yesterday. So there's two things that can happen. We snap back, or we plot a slightly higher candle that's a narrower range, and that would be sort of the second candle of a minor high pattern. What's a minor high pattern look like? Just to kind of mock it out here, it looks like this. Big candle, all right, little candle, sometimes higher high, and then something like that. And what's left behind, this right here, is the minor high. Okay, it's a 3-candle pattern. On a 1-minute chart, on a daily time frame, doesn't matter. Now, yesterday I said there is the opportunity to buy the UNG puts on this candle, but the risk is you might see a little bit more movement higher and take some heat on that position. Heck, we could have seen a lot more move higher and a significant amount of heat on those puts, but this is the risk. We could just see the market snap back, and today gives us really no opportunity to build more UNG. But look, at the same time, we still have some of the UNG put options from before. And for some of us, we might have already scaled out at the profit target, and some of us might be looking for that next opportunity. So I'm not ruling out more opportunity in natty gas, but I am acknowledging that the downtrend that we've been trading since really November is not anywhere near the quality that we had going into March. I mean, since March, we've seen a lot more volatility, a lot more choppy volatility. So it is not this glorious downtrend that we've seen in the past. Okay, not the same quality. And as we sort of ease up on our involvement in the shorts, I'm still short. My bias is still at the short side, but I'm not going to go after them as aggressively. So, it's the same kind of conversation when we take a look at crude. I've got a lot of questions on crude. But here's the thing, gang. We've been bearish on crude a really long time. We've been bearish crude. We've been bearish RBOB. This is nothing new, right? What are we doing? Pure trend following. What are we doing? Looking for red grab candles, looking for the propulsion dots, looking for bounces into the wave. So, this is what we're focused on. These kinds of moves into zones that we would do what? Short in. We don't step in to start talking about, well, crude's at historic lows. Well, crude demand is going to pick up. Well, crude couldn't go any lower. Yesterday's move in May is such a great example of the XYZ can't go any lower trade going about as horribly wrong as it could possibly go. And maybe if you're one of those folks who likes to be a bottom picker, and you've not ever experienced something like what CLK May Crude did, take a snapshot of this chart. Heck, print it out. Remind yourself. Go with the flow. If there's typically going to be an acceleration in the direction of anything, it's going to be in the direction of the flow that's already established. It's amazing how that flow reflects the macroeconomic structure, the supply-demand structure, and flat out the simple market structure, right? It's amazing how often the probabilities are, if we're going to see an acceleration, it's going to be in the direction that we're already moving in, okay? RBOB I like a lot as well because, gosh, with a glut of crude, guess what else we're going to have? A glut of RBOB gas. Tons of it. So do I like the RBOB short? I sure do. I mean, we know what our pump has been looking like. It's looked the best it's looked in a really long time. So the thing to remember here is, can we continue to see bounces into the wave, into the 21 EMA, and short into those bounces? Absolutely, right? Could RBOB end up with something similar as crude? It could. It could, and this is where I'm going to bring up the alternative of USO and UGA. Now, gang, the words lights out have actually been used around USO. USO, the ETF, it could cease to exist. I'm not trying to be dramatic, but there is a possibility that it could cease to exist. Now, the USO ETF has all of a sudden, and I'm not sure where the regulation is on this, but they have pretty much reinvented themselves. All those halts that you saw on the US Oil Fund today were restructuring, recomposition. Normally the USO, which by the way did not own May crude, it had rolled out, as most of us do anyways. We roll out about 2 weeks in advance of the expiration. That's what we do. That's what I talk about. That's what I teach in the room. So they didn't own May, but they own June. And June, we know what happened to June. So now what do they own? They own 40% June, 40% June, 55% July, and 5% August. That's the recomposition over the course of, I think, 3 halts today. And as you take a look at the statements that have accompanied those, the U.S. Oil Fund has really turned into some weirdo hedge fund. They now are basically saying, we'll do whatever we need to do to keep this thing open. I mean, there is a real chance that this particular ETF might be the first in history that I know of. Well, it can't go below zero. It cannot go below zero. But this is a significant, well, I'm not going to say that it can because it can't. I've double checked. I wasn't sure this afternoon when all they own is West Texas Intermediate across these 3 contracts. I'm not sure they can do what they're doing. I'm not sure that regulators don't step in. I've never seen an ETF change its composition like this. Not ever have I seen something like this. So we're in very uncharted territory, which is my way of warning you. There's a chance this thing could go to zero and just stay there. They're doing their best not to, but they're constantly changing the composition. Again, this would have normally been a lot of June and only June futures contract or West, deliverable WTI contracts. Now it's June, July, August. Right? That's a significant change to the way the USO ETF has operated. Okay, So just keep aware of that your risk is zero, okay? UGA is another market I would keep an eye on if you want to play some of these but not play the futures contracts, or you want to play puts in the futures or puts in the UGA or puts in the USO. Keep in mind, if we do see some sort of rip higher towards 13 in UGA, which is your United States Gas Fund, which is going to mimic what we see in RBOB, I would be fine with puts, and I would be fine with shorting this $13 ETF. But clearly the puts give us the leverage, the gorgeous leverage of the option, right? We love leverage. Forex, futures, options, that's what we love. So if we can move higher into the wave on RBOB, UGA is an alternative for that short. Okay, speaking of sort of the signs that something is not quite right with the economy, and gang, I know that there's a lot of different opinions, but I'm going to give you mine, and that's kind of my job, right? I do not believe that yesterday's issue with May was just some sort of, financial thing. I don't. There's nowhere to put this stuff because nobody wants it. There is very much, this crude oil market is screaming at us, meaning traders and investors, the economy, that something is not right here. And I don't mean there's not enough containers. I mean there's not enough demand. You cannot production cut your way into an uptrend. You can production increase your way into a downtrend, as we've seen OPEC do by overproducing, and not just OPEC, gang, OPEC plus, OPEC, and yes, the U.S. We've been overproducing. Overproducing related to what? Demand. Demand has been dropping. In fact, the EIA, OPEC, OPEC plus have all said before the coronavirus, we expect less demand in 2020. All right. So we're already going into a year where there was going to be less demand for crude, and now, this pandemic sweeps around the world, and of course, it's far less than anybody could have expected in terms of this lack of demand. Okay, so they can talk about production cuts all they want, but until traffic picks up. Now, a lot of you have asked me, Rob, where do you get this traffic data? I put it in today's notes. TomTom, gang, TomTom. They make this available for free. And what I do is I look at different cities and I look at their traffic. China was the first place I looked. We can look at 4 different major cities in China. What are we looking for? We're looking for not just people going to work. We're not looking for rush hour traffic peaks. We're looking for midday. That's typically your industrial production, your industrial output, your trucks on the road. And we're looking for evenings and weekends. What is that? That's folks going out to eat, going to the movies, buying stuff, living life. It's not just the consumer in the U.S. that has kept the U.S. economy afloat. The consumer has been a big part of global economic makeup in terms of economies staying afloat. The consumer and having the consumer, get out there and eat things and buy things, and you know how that works, right? Until they get back out in the evening and in the weekends, which we can measure with this data. I'm looking at Mumbai right now. But until, here's all the different cities you can look at. Here's Beijing. Until we start to see people do more than just go to work, we're not going to see traffic pick up, okay? Look at this. You might say, well, gosh, Rog, these peaks don't look so bad. That's rush hour, gang. That's 8 a.m., that's 6 p.m. That's 8 a.m., that's 6 p.m. We're still not seeing a lot of what we need to see, which is, see this chasm in here? That is what we are lacking. That's what we are lacking. That's Monday. Here's Tuesday. Right? We're not seeing that. And then we want to look at the weekend and evening data. That's really important as well. So that has to pick up to show us that there's a recovery going on. Traffic is telling us there's still no real big demand for crude, and the consumer has not rebounded. Traffic can tell us a lot. Okay. All right. Next up, let's go back to copper. What is copper saying? Copper's been in a downtrend for darn near as long as crude. Crude and copper are the canaries in a coal mine in terms of reflecting what's happening in the global economy, and they've had nothing good to say since 2020, long before coronavirus was part of our daily conversation and lives, right? Crude and copper, the demand for that has not been there. We've seen these prices go lower and lower and lower, and that tells you something that the stock market's not going to tell you, which is global economies are not expanding. If they are, commodities are in demand. We are in what I was taught and what I call a D stage of the economy, the downturn. Falling inflation, falling growth. That is the stage we're in. and what we expect in this stage. Actually, let me show you here. What we expect in this stage right here, this downturn, is falling GDP, falling inflation, a transition from hawkish neutral to dovish. Sometimes that transition can come very quickly from the monetary policy, and dollar liquidity. You see the dollar is very liquid. And really what you have is, typically I'm going to be long construction and home builders, but this is not your garden variety downturn D stage. What I'm looking at is gold. I'm looking at defensive. I'm looking at bonds, as I've described here. So this D downturn is clearly different than other D downturns, but generally speaking, the measurement of them is pretty normal. When do we know we're coming out of a D? You'll start to see financials. You'll start to see emerging markets start to level out. We're nowhere near that right now. Okay, so this is where we're at. And also, what happens at this D stage is commodities get hammered. I think we're only beginning to see what crude and copper have told us for a while. We're already seeing soybeans. We're already seeing corn. We're already seeing meats. We really need to get back to sort of the look at the grocery store of the world. How do we look at that? We do that by going to FinViz. We do that by going to the futures performance for the quarter, even for the month, looking at which commodities, not just currencies and indices, gang, commodities, what is not in demand. Look at the bottom of this: crude oil, Brent, heating oil, hogs, meal, ethanol, corn, sugar, cattle, coffee. Here's RBOB. What's at the top? Platinum, palladium, NASDAQ, silver. And this is the last 1 month. All right. Natural gas has been moving up a little bit, but that's because it's choppy and pretty volatile. So you can get an idea of just the lack of demand for, again, what I call those grocery store commodities. We'll talk a lot more about this tomorrow. We also have our EIA inventories number. Gang, I'm not expecting a lot of fireworks with that. I don't generally find EIA to be something that most traders should even venture into, because you've seen the wicks. They're crazy wicks. What I would recommend, and we'll talk about this tomorrow, is when that data hits, and check out the free video, by the way. When that data hits, if it can wick up to a level that's an expected price movement range or hourly price movement range level that we can engage after the volatility, there might be something there. But I'm not going to roll the dice on an EIA release. But we'll talk about that tomorrow because we have that at 10:30. By the way, in the meanwhile, we have seen that the markets have, let me show you here. We're getting the reopening. It's just after 6. Markets are moving a little bit higher, as you can see here. Why are they moving a little bit higher? Mo money. That's why we just had the Senate pass a $484 billion COVID-19 relief package for small business. It passed unanimously, and so clearly that's going to be something the market has been expecting. It will rally a little bit on it, but this is not new news. This is going to be a buy the rumor, sell the news, generally speaking, I believe. So we'll see how the Asian session pans out. Keep an eye on the Forex performance for where the yen and the Australian dollar are on all this as we go into the Asian Open. Pretty quiet right now. It's a little too early. About 8 p.m. take a look. 9 p.m. Eastern, take a look at where we are, and we'll get a pretty good idea of how the Asian markets are interpreting everything that happened in the U.S. markets today. I'll see you in the next update.